answering your questions about retirement. It's Money Talk with Michael Eastham.
I trust my advisor, but I don't really understand what I'm invested in. How do I know I'm not taking on too much risk?
Risk is a critical term to understand as you approach retirement, especially when you're looking at your portfolio. And unfortunately, I've seen a lot of folks who are in your situation who maybe they just trust their advisor, but they still look at their investment portfolio and they don't really understand what they have and how much risk they're really taking. So it's critical from my perspective to make sure that you do understand how much risk you're taking. Here's a simple question to ask. If your investments dropped by 50% when you're retired, would you be okay with that? If the answer is no, which I'm assuming is the case for most people, then you have to make sure that you understand how much risk you're really taking. I've had people come into my office and say, listen, I'm not comfortable with more than a 20% drawdown on the value of my portfolio in retirement. And then when we stress test their existing portfolio, their advisor told them that they're in a conservative portfolio. But when we stress test it, we show that a market drawdown of 50% could mean that they're going to lose 40% or even 50%. That means that you're taking on a lot more risk than you thought you were. So understanding how that looks is critical to giving you the peace of mind that you need to sleep well at night in retirement. And one of the ways we can do that is to stress test your portfolio. Look at the amount of expenses that you're paying in your portfolio, the amount of actual income that you're generating, and the amount of actual risk that you're taking. Because the last thing you want to have happen is to be retired, cut the cord, so to speak. Now you're not working, having to rely on your investments, knowing that if the market takes a downturn, that you still have to draw income out of that portfolio. If your income is based on the market value, then with a 50% drawdown, that means in order for you to get the same amount of income, you have to sell twice as many shares at the bottom of the market as you do at the top. That can be dangerous for retirees. In fact, that's one of the most cancerous financial strategies that I see retirees taking because they don't understand how much risk they're taking. We can help you define that and walk away clearly having a handle on what your true, real risk exposure is simply by helping to run that stress test. Hope that's helpful. If you like this information, please make sure you like and subscribe our channel so you get more updated information just like this on a regular basis. Thanks so much for that terrific question.